Most of you already know the type of approach I study when it comes to Bitcoin and crypto markets. I focus on higher time frame analysis, looking at broader market structure rather than short-term noise. The goal is not to predict exact price movements, but to understand context, probability, and risk. Before we go further, quick reminder. This content is for educational purposes only and does not represent financial advice. Now, let's break down what we are currently seeing in the Bitcoin market. When analyzing positions, one important concept is scaling into trades. Instead of entering with full size at once, smaller initial entries are often studied as a way to manage uncertainty, especially during volatile periods. Early entries can experience drawdown. That's part of market behavior, not necessarily a mistake. Looking at the broader picture, the market structure still shows signs of a bearish trend on higher time frames. Historically, in previous cycles, major bottoms did not form instantly. They typically developed over longer periods, often with slow, ranging price action before any sustained move upward. Right now, price action suggests that the market is still in a ranging environment, with occasional moves above key levels. From a technical perspective, we are observing reactions around important zones such as previous fair value, gaps, and retracement levels. We're also interacting with areas that previously acted as resistance over extended periods. These are the kinds of levels traders study closely, because they often represent areas of interest for both buyers and sellers. Another important observation: the market has moved significantly from previous highs, and historically, similar conditions have required time before a clear bottom structure is formed. This aligns with a broader concept in market analysis, that liquidity tends to build over time. Markets don't just move randomly. They often move toward areas where liquidity exists, which is typically where many participants have placed orders. In ranging conditions, it's common to see deviations above or below key levels. These movements can sometimes act as traps, where market participants are positioned on the wrong side of the move. From an educational standpoint, this is often referred to as redistribution, where positions are gradually shifted before the next larger move. It's also important to understand that trader behavior plays a major role. When price moves in one direction, many participants react emotionally, entering late or exiting too early. This behavior contributes to how liquidity forms and how price eventually moves. The key takeaway here is not about predicting exact outcomes, but about understanding how markets typically behave over time. Patience, structure analysis, and risk management are essential concepts worth studying. Markets move in cycles. They require time to build structure, and they often move in ways that challenge the majority of participants. So instead of reacting emotionally to short-term moves, the focus should always be on understanding the bigger picture. Again, this is not financial advice, just an educational breakdown of market behavior and concepts. If you're interested in learning more about how markets operate from a structural and probabilistic perspective, consider following along for more content.